Imagine you've taken out a loan and you're worried that interest rates might rise in the future. Or maybe you think rates will fall and you want to benefit from that. What if you could swap your interest payments with someone else to better match your expectations? That's exactly what an interest rate swap allows you to do. An interest rate swap is a financial agreement between two parties to exchange interest payments on a notional amount over a set period. Notional amount is just a reference. No principal changes hands. Both parties calculate interest on this amount and then swap the payments. Typically, one party pays a fixed interest rate and the other pays a floating rate, often tied to benchmarks like SOFR or LIBOR. In simple terms, one party says, "I'll pay you a fixed rate." The other says, "I'll pay a variable rate," and they exchange payments periodically. Interest rate swaps are mainly used for risk management and speculation. Risk management, hedging. Imagine a company with a variable rate loan. If rates rise, payments increase. Entering a swap to pay fixed gives predictable costs. Speculation. Traders use swaps to bet on interest rate movements without owning the loans or bonds directly. Suppose two companies. Company A has a floating rate loan but prefers fixed payments. Company B has a fixed rate loan but prefers floating payments. They agree on a swap with a notional amount of $1 million. Company A pays 5% fixed. Company B pays SOFR plus 1% floating. Every payment period, Company A calculates 5% on $1 million. Company B calculates the floating rate on $1 million. They exchange the difference. If floating is greater than 5%, Company B pays the difference to A. If floating is less than 5%, Company A pays B. This continues for the swap's duration. Key features to remember: no principal exchange, only interest is swapped. Net payments, usually only the difference is paid. Customizable contracts, duration, rates, and payment frequency can be tailored. Counterparty risk, one party may default, so risk exists. Interest rate swaps are widely used in global finance. They help companies stabilize cash flows, manage risk, and optimize borrowing costs. Banks, corporations, and even governments rely on swaps to navigate changing interest rates. So while swaps may sound complex, they're really just a smart way to exchange financial risks and opportunities. And that's how it works, turning uncertainty into strategy.